Welcome back to the deep dive. It's easy to feel totally overwhelmed by financial news, especially with the stock market these days. You're just bombarded with data, headlines, conflicting opinions. It can feel like you're drowning, but that's exactly why we're here. We try to cut through all that noise and hopefully give you some clarity. Today, we're taking a deep dive into the incredibly complex cross-currents shaping the U.S. stock market right now. We're really talking about the unpredictable, almost dizzying influence of trade policy, and crucially, how different companies are reacting. It's shifting sands, for sure.
That's right. And our mission in this deep dive is, well, it's to dissect the very latest market analysis we've got, clarify those often opposing viewpoints you mentioned, and help you identify the signals that really matter. We want to provide a clear, actionable framework, help you understand what's truly driving stock movements, and most importantly, how it might impact you and your portfolio. We're aiming for those aha moments, helping connect the dots in what can feel like a pretty chaotic market.
Exactly. And to do that, we're drawing heavily from a comprehensive source, a daily multi-strategy market analysis and action plan report. This one's specifically for July 8th and 9th, 2025. It's packed with insights, and we're going to pull out the most important nuggets for you. Okay, so let's unpack this. We should probably start with the baseline, the macro picture. The market seems to have largely, maybe surprisingly, already digested some key things. We're seeing moderating inflation numbers. The Consumer Price Index, CPI, showing headline inflation at 2.4% year over year, core at 2.8% for May 2025. Decent numbers. And the Fed, in response, seems to be in a clear wait-and-see mode. Fed Chair Jerome Powell even hinted they'd probably be cutting rates right now.
If it weren't for the tariff uncertainty.
Yeah.
That's the big asterisk, isn't it?
Exactly.
What's fascinating here really is how much power has shifted. It means monetary policy, which usually steers the ship, has kind of handed short-term control over to geopolitical news. U.S. trade policy is now the main variable. It's like a coiled spring, just waiting. A rapid market response could come from any definitive news on the trade front. It's a pretty rare situation where headlines, not interest rates, are the immediate driver.
And the news flow on tariffs is, well, it's anything but simple. It's incredibly fluid, changing almost daily, it feels like. We've got these new threats, like President Trump's fresh warning of an additional 10% tariff on nations supporting the BRICS bloc. That could really widen the conflict. Plus, there's escalating rhetoric ahead of that key July 10th deadline for trading partners. Deals or levies, basically. But then you also see conflicting signals, right? Trump softening his stance on Japan, South Korea, Malaysia tariffs, delaying them to August 1st, signaling negotiation.
It's the classic carrot and stick approach, absolutely. Keep everyone guessing.
And it's not just broad policy. The report flagged something interesting, more specific, the friction between Elon Musk and Donald Trump, apparently putting direct pressure on Tesla, TSLA stock, and maybe casting a shadow over other high beta tech names too. It just shows how these individual spats can become market catalysts.
Exactly right. And the market isn't pricing a simple yes-no on tariffs. It's trying to figure out a complex matrix. Which countries, what rates, any exemptions, when does it actually hit? Look at that recent Vietnam deal. It ended up being 20% tariffs, not the 46% first floated. That's kind of a blueprint. It suggests negotiated outcomes might be less severe than the initial threats. That's where opportunities lie, if you can read the nuance. The key thing for you, listening, is the market's thinking in probabilities, not certainties.
Okay, so probabilities. Based on this really volatile tariff variable, the report lays out 3 high likelihood scenarios for, the next 24 hours. What are they? First up, scenario A, risk on de-escalation. Given about a 35% probability, what triggers that?
That'd be positive headlines. Say, a breakthrough in the India-U.S. mini trade deal everyone's watching, or maybe Trump formally extends that August 1st deadline for others. If that happens, expect a relief rally. S&P 500 pushing towards highs, leadership broadening out maybe to cyclicals like materials, financials, maybe even small caps catching a bid.
Okay, 35% for good news. What's next?
Scenario B, neutral consolidation. This actually gets the highest probability, 45%. This is basically nothing much happens, a lack of big trade headlines, the market just treads water, digests the recent sell-off, waits for July 10th. You see choppy, range-bound trading. Volatility stays elevated, but kind of contained, just waiting.
Right, the waiting game. And the third scenario, the downside.
Scenario C, risk-off escalation. Lower probability, 20%, but definitely impactful. This is triggered if the administration issues formal, non-negotiable tariff notices or actually follows through on that BRICS threat. Or maybe the India-U.S. deal publicly collapses. The impact. Sharp sell-off. S&P 500 likely breaks below key support levels. Money rotates quickly into defensive plays, utilities, consumer staples, that sort of thing.
Okay, so those are the short-term possibilities. How does this connect to the bigger picture, the longer-term view? Because you hear some pretty bullish targets out there, too.
Yeah, that's the conflict, isn't it? You've got these bullish long-term institutional outlooks. Goldman Sachs talking about S&P 6,600 by year-end, for example. Strong forecasts. But that's bumping right up against this immediate headline risk from trade policy. It's macro fears versus fundamentally strong corporate earnings expectations, a real tug of war. And this also feeds into that really crucial theme we're seeing develop. Sector rotation beyond just the magnificent 7 tech giants. We've already seen materials, financials, energy doing better than tech recently. If we do get de-escalation on trade, you could see capital accelerate into those lagging, more economically sensitive sectors. They look cheaper, valuation-wise.
Okay, that's a great setup of the macro environment. With that picture in mind, let's turn to how these forces are playing out in specific companies, because, that's where the rubber meets the road. And here's where it gets really interesting, I think. Looking at specific stocks, how they embody these dynamics, these conflicting signals. Let's kick off with NVDA, the dominant momentum play right now.
Absolutely. NVDA is, well, it's the main way the market expresses a view on the whole AI theme. And its price action is a key barometer for risk appetite overall. I mean, it just became the world's most valuable company, crossed $3.92 trillion market cap. That alone attracts huge attention, huge volume.
It really does. It feels like everyone is bullish on NVIDIA right now.
Yeah.
So what's the analysis say? How does it actually look under the hood?
Well, technically it is overbought. The relative strength index, RSI, is above 70. Usually that signals a potential pullback is due, like a car's speedometer in the red zone. And this is it's momentum indicators. Things like ACD and on-balance volume are just overwhelmingly bullish, still pointing straight up. And this is important. In a powerful secular uptrend like NVIDIA seems to be, that raw buying pressure, that momentum, often just dominates those traditional overbought signals.
Right.
Plus, you've got huge institutional ownership, almost 74%. And the options market shows a really strong skew towards call options. It confirms this is a very crowded long trade.
Crowded long, yeah. So lots of people betting the same way. What's the final take then?
All signs still point to a continued bullish bias. We'd say medium confidence, though. Because while it is extended, momentum is king right now for NVIDIA.
Okay, momentum rules for NVIDIA. Let's switch to Apple, AAPL. This one seems to present a fascinating conflict, doesn't it? Between the tech chart and the sentiment around it.
It really does. Apple's usually seen as a proxy for global consumer health, mega cap stability. But that innovation story, it's definitely under pressure lately.
So this raises that important question. How do you actually reconcile conflicting signals when you see them? Apple seems like a prime example.
The conflict is pretty stark here. Technically, it's been trading in a sideways channel. It managed a weak bullish breakout recently near $213. Looked okay, maybe, but then, bam, July 7th, a really decisive negative sentiment signal hits. Multiple class action lawsuits filed.
What are they alleging?
Alleging Apple misled investors about its AI capabilities, about Siri. This hits right at the heart of Apple's growth narrative.
Oof. Okay, so that sounds like a powerful fundamental catalyst, just crashing into a pretty weak technical setup. How do you resolve that? Which signal wins?
We approach this using what the report calls logical branching. Think of it like 2 paths. Path 1, the weak technicals hold. Path 2, the strong negative sentiment prevails. In this case, the analysis strongly suggests path 2 is the higher probability. The lawsuit isn't just background noise. It's specific, it's material, it's fresh negative news. It's very likely to overwhelm those weak technical signals. It could easily turn that little breakout into what's called a bull trap.
A bull trap, meaning it looks like a buy signal but then collapses.
Exactly. It lures investors in on the breakout, then reverses sharply lower. And this Apple situation, it's more than just one stock. It's kind of an aha moment for a key market principle. Sometimes fresh material news, especially negative sentiment like this, can completely overpower a technical chart pattern. Our final bias for Apple is therefore bearish, with high confidence based on this fresh news.
Bearish, high confidence on Apple. Okay, shifting gears again, let's look at First Solar, FSLR. You mentioned this one's a pure play on U.S. trade and tariff policy. Makes it super sensitive to headlines.
Incredibly sensitive. It's been extremely volatile, reacting to budget legislation news, tariff rumors, you name it.
And its quantitative profile is interesting. What does that mean?
Yeah, the numbers are key here. It has elevated short interest, 10.37% of its float. That means a decent chunk of investors are betting against the stock. And importantly, it would take over 3 days of average trading volume for all those short sellers to buy back their shares and close their positions. That's called days to cover. That setup creates massive potential for a short squeeze if the stock does start moving up quickly. Sentiment overall is kind of neutral, cautious. Analysts are pretty divided.
So given how much FSR hinges on these tariff headlines, is it really just a coin flip until we get that news, or are there other subtle indicators to watch?
For FSLR, it really does boil down to a binary, catalyst-dependent outcome right now. It's all about the trade news. A positive headline, say, a good deal for solar. Exemptions granted that could trigger a violent short squeeze. Price could break above $183.88, maybe target $195. But conversely, negative news, like confirmed new tariffs hitting them. That likely leads to immediate algorithmic selling. Price could break below $175, head towards $165 pretty fast.
So it's all about the catalyst.
All about the catalyst. The final bias is neutral, but with high volatility expected. It's entirely dependent on those trade headlines. Wait for the signal.
Got it. Okay, let's talk about Palantir, PLTR. This one's more speculative, right? A high-growth AI trade, sometimes seen as like a higher beta, riskier version of NVIDIA.
That's a good way to put it. Palantir is a real battleground of narratives right now. You've got incredibly fervent retail support. Check out Reddit or Wall Street Bets. They champion its irreplaceable AI software, its government contracts, very vocal bulls. But that's now clashing head-on with emerging institutional skepticism. Just on July 7th, the Motley Fool published a really detailed bearish analysis. The title was blunt: 7 reasons Palantir stock can plunge at least 60%.
Wow, 60% plunge. That's direct.
Very direct. It squarely challenges the bull case. So this creates a pretty significant inflection point in sentiment. You've got 2 very strong opposing camps.
So where does that leave the bias?
Given that clash, our bias here is neutral to slightly bearish, with medium confidence. The negative arguments are gaining traction and need to be watched closely.
Right. And finally, the really wild one, Wolfspeed, WOLLF. A deeply distressed semiconductor company, but the report says it's seeing a historic confluence of catalysts. It surged over 100% just yesterday, July 7th.
Yeah, WOLF is extreme. The quantitative data is just off the charts. We're talking astronomical short interest. Some reports put it as high as 49.61% of the float.
Almost half the available shares are shorted.
Almost half. And the cost to borrow those shares, the fee short sellers have to pay, it peaked at an unbelievable 459% annualized rate. That's immense pressure on shorts. Now, combine that with a restructuring announcement, which gives maybe a tiny glimmer of fundamental hope, a reason for the squeeze to start. It's the ultimate sharp confrontation of ideas we talked about aiming for. You have terrible underlying fundamentals crashing head-on with overwhelming force-buying squeeze mechanics, and the options market is just as extreme. Overwhelmingly bearish puts a put-call ratio of 4.42. That setup can fuel a gamma squeeze.
Explain the gamma squeeze quickly.
Right. When the stock price rises fast, dealers who sold call options are forced to buy the stock itself to hedge their position. This buying pressure adds even more fuel to the rally, creating a feedback loop. It accelerates the move upwards.
That sounds like a true market phenomenon. Unbelievable numbers. So what's the outlook for Wolf after that massive move? Can it continue?
The final bias is actually bullish, but, and this is critical with extremely high risk noted, the squeeze mechanics are dominating everything else in the short term. It's pure momentum driven by forced buying from trapped short sellers. But anyone even thinking about touching this needs to understand the underlying fundamentals are still, frankly, terrible. The risk is definitely not for the faint of heart.
Okay, wow. So we've gone from the macro view down to these really specific, sometimes conflicting stock situations. Let's zoom back out, connect these dots. What does this all mean for you if you're trying to navigate this market? What are the broader strategic insights?
Absolutely. There are some deeper market implications to pull out. First, think about what we call the tariff echo effect. The market's intense focus on tariff news right now creates a pretty predictable pattern of contagion. An announcement hitting one sector, like solar impacting FSLR, often causes an immediate ripple, an echo in other sectors people think might be next. Maybe auto parts, maybe other tech areas. This creates potential anticipatory trading opportunities if you can figure out where that capital might rotate next before the actual news hits those sectors.
That makes sense. Kind of like reading the tea leaves based on the first announcement. What else?
Then there's the Wolf volatility crush opportunity. The implied volatility on Wolfspeed options, basically. The market's expectation of future price swings hit historic highs. An IV rank of 100%. Max fear, max uncertainty priced in. Now, while the stock price itself is wild, any resolution to the squeeze, whether it keeps rocketing or collapses back down, will likely cause that inflated volatility premium to evaporate fast. This presents a more advanced trading idea, selling options premium. It's a bet not on the stock's direction, but on the expected decrease in volatility itself once this chaos eventually settles down. Requires options knowledge, though.
That's a fascinating insight. Betting on volatility to decrease amid the madness. Very interesting. And what about the Apple situation? Does that have broader implications beyond just AAPL stock?
It absolutely could. The AAPL AI narrative contagion is something really critical to watch. Apple's public struggles, these lawsuits, questioning their AI delivery. It could be a canary in the coal mine for the whole market. If investors start looking harder at the massive AI spending across all the Magnificent Seven and asking, okay, where is the actual revenue? Where's the profit from this yet? It could trigger a wider reevaluation, a valuation derating. Apple's problems might shift the market focus from just the promise of AI to the actual proof of monetization. That could be a headwind for other big tech names that have ridden that AI wave.
Okay, lots of interconnected things there.
Mm.
This all boils down to action, though. So let's get to the strategic ranking of trade setups. Give us some clear advice, a potential plan based on this analysis.
Right. Let's rank them by conviction and profile. At the very top, highest conviction setup, suitable for maybe a balanced or aggressive approach. Apple, bearish. Why? Because you have that fresh material negative catalyst, the lawsuits aligning pretty well with weakening technicals and sentiment. It offers a relatively clear risk-reward profile right now.
Okay, highest conviction, short Apple. What about highest potential reward for those with higher risk tolerance?
That would have to be Wolfspeed, bullish. But again, extremely high risk emphasized. The squeeze mechanics are just completely dominating everything else there. The upward momentum is violent, purely a trade on mechanics, not fundamentals.
Got it. And for someone wanting a direct macro play, maybe tied to the tariff news itself?
For an aggressive trader looking for that direct macro play, First Solar, bullish on de-escalation news, stands out. It has that defined catalyst trigger positive trade news and that explosive short squeeze potential we discussed due to the high short interest. But you need the news trigger.
And where does NVIDIA fit in this ranking?
NVIDIA bullish is still a strong momentum continuation play. The trend is clearly up, but the entry timing is tricky given how overbought it is. So it's more of a balanced fit, perhaps, for those comfortable managing momentum trades.
Okay, that clarifies the potential opportunities. But just as important is what not to do, right? Any explicit warnings?
Yes, absolutely. The report is very clear on the not recommended trade. Do not try to bet against Wolfspeed bearish right now. Don't try to short it. Trying to time the exact top of a historic mechanics-driven short squeeze like this is incredibly dangerous. One of the quickest ways to lose a lot of money. Just stay away from shorting Wolf for now.
Sound advice. What an incredible deep dive today. We've really tried to move beyond just the raw data and offer a structured way to understand how these conflicting signals, these complex forces, actually resolve in the real market, hopefully giving you some clarity.
And maybe that leads to this provocative thought to leave you with. In a market where narratives constantly clash, where news is just this nonstop deluge, how will you personally identify the true material catalysts, the things that cut through the noise and genuinely shift the probabilities? And critically, what weight will you give to market sentiment versus underlying fundamentals when you're making your own investment decisions? Something to really ponder.
Food for thought indeed. And to make sure you're always equipped with these kinds of insights and get the fastest, most frequent updates to stay well informed on these crucial market shifts, please make sure you subscribe to The Deep Dive. We'll be back soon with more analysis. Thanks for joining us.